Let's do a quick review of some things that we've learned already about mean variance analysis. So let me go back to the whiteboard here, and we'll see that here is expected return, and here is standard deviation, that when you have different assets, each asset has its own expected return, its own standard deviation, and different combinations of assets, portfolios, each one of which has their own expected return and standard deviation. If we are to take a look at what are all the possible portfolios that are out there, combinations of assets and individual assets, and we plot them here, they're going to plot inside this hyperbola. So every asset, every combination of assets is going to be inside the hyperbola here, except for the risk-free asset, because the risk-free asset has a standard deviation of 0. So this is all risky assets here. And we said that you can combine the risk-free asset with any asset, but the best asset to combine it with is the market portfolio, because the market portfolio, which I'm going to denote M here, is going to be at a point on this hyperbola, on this curve, where the line, what we call the capital market line, going from the risk-free asset up through the market portfolio, is tangent to the hyperbola. This is called the capital market line because it goes through the market portfolio. So as we can see, any point on the, let me say it this way, any point inside the hyperbola is dominated by a point, at least one point on the capital market line. This point right there, you can get both a higher expected return and a lower standard deviation here. This point right here, you can get a higher expected return and a lower standard deviation there. So any point here in or on the hyperbola, you can get a higher expected return and a lower standard deviation on the capital market line, except for M itself, okay? Then because that is also on the capital market line. So what this does is it leads us to the conclusion that risk-averse investors will all choose the same risky portfolio to invest in, the market portfolio. And so what is going to be different about different risk-averse investors is their combination, their weighting on the risk-free asset and the market portfolio. My mother-in-law, she's going to be way down here. She's going to put all her money into the risk-free asset, or almost all of it into the risk-free asset. Some of us might be up here where we put some money in the risk-free asset, some in the market portfolio. Some of us might be here where we invest all our money in the market portfolio. And some of us might be up here where we are putting all our money in the market portfolio, borrowing some money, leveraging, and putting that in the market portfolio as well. This gives us up here a weighting of greater than 1 on the market portfolio and a negative weighting on the risk-free asset that we have up there. Now, sometimes I get students will say, wow, that must be an investor who is really a risk taker. That would be very few investors would actually do that. Well, actually, if you look at everything you own as a portfolio, which is really the way you should do that, there's probably some of you in this class who are up there and you don't even know it. If you have both a mortgage and a 401k plan, you're going to be up here. Because what are you doing? You're putting all your money into, it may not be exactly the market portfolio, but it's some sort of probably a well-diversified portfolio, right? That's right here. And then you are also borrowing money so that you can put that money into the market portfolio. Hey, if you had to pay off your mortgage, you probably wouldn't be able to have all that money in the 401k plan. So that actually puts you up here. But most of us don't look, this is a whole nother lesson, but most of us don't look at our entire holdings as our portfolio. We kind of tend to segment it into different buckets. But at any rate, the market portfolio, we said, is sum of every risky asset in the world, specifically in with the weights being according to the their market values. In other words, the assets that have the highest market capitalization, the highest market value, they're going to get the greatest weighting. The assets that have the lower market capitalization, they'll get the smaller weightings that are in there. And this, by the way, the whole idea really still pretty much works out, even if this isn't exactly the market portfolio. If this is a well-diversified portfolio, it pretty much works out the same way. But we're going to say it's going to be the market portfolio here. So where do we go from there? Well, what matters now to us, okay, is not the riskiness of an individual asset. It's going to be the riskiness of the market portfolio, because that's what we have. Remember, your portfolio is your team. And as the coach of the team and the owner and the general manager, you are mostly concerned with how does the team do. So let's say, for example, that we have this market portfolio right here. Here's our market portfolio. And we have an individual asset. We'll just call it asset I, okay? And let's suppose it's a brand new stock that has come out. Nobody is going to own asset I by itself. Nobody's going to just go out and buy asset I and say, that's the only thing that I own. No, because everybody holds the market portfolio, a combination of all the risky assets, that and the risk-free asset. So what is of interest to us is not the level of risk in asset I, but how it affects the risk of the market portfolio, because everybody's going to hold some of asset I as part of the market portfolio. So again, what's of interest to us is not how risky is asset I by itself, but how it affects the risk of our team, the market portfolio. When I add asset I to the market portfolio, does it cause the standard deviation of the market portfolio to go up, or does it cause it to go down, or does it keep it exactly where it is? That's what matters, which means we have to go back and take a look at our weighted variance covariance matrix again. So now we've got a really big variance covariance matrix, don't we? The entire market. So every asset in the market has its own column, and every asset in the market has its own row. So we've got thousands and thousands of columns, thousands and thousands of rows. But as always, all of the assets on the diagonal are going to be variance terms. Everything on the off diagonal is going to be covariance terms. So there's one variance cell for each one of the assets, but there's going to be there's going to be zillions more covariance terms than that. So what happens now, as I add asset I to my portfolio, okay, when we go back here, when we add asset I to my market portfolio, we are now adding one more column here to the matrix, and we are adding one more row. Okay, there's column for asset I, and there's a row for asset I. Now we're adding one more cell here, and that is the variance of asset I. But we're adding thousands of covariance cells here, and we're adding thousands of covariance cells there. There are so many covariance cells that we are adding, and just one variance cell that we're adding, that we can pretty much ignore this one variance cell. It's so insignificantly small, we don't really worry about what is the variance of asset I. What matters to us is what is the covariance between asset I and the market. You see, if asset I has a high covariance with all these other stocks, or a high covariance with the market, then when we add asset I to the market portfolio, it's going to increase the standard deviation of the market portfolio. However, if asset I has a low covariance with the market, we're adding a bunch of small numbers here for the covariances. Then when asset I is added to the market portfolio, it's going to decrease the standard deviation of the market portfolio. Now, remember, as a risk-averse investor, we like lower standard deviations. That tells us we want asset I to have a low covariance with the market. If asset I has a low covariance with the market, it's going to reduce our risk. We like that. If asset I has a high covariance with the market, it's going to increase the risk of our market portfolio, and we don't like that. So how do you determine if asset I has a high covariance with the market or if it has a low covariance with the market? What we need to do is we need to figure out what is an average covariance with the market. And so then if asset I has a higher than average covariance with the market, we don't like that. If it has a lower than average covariance with the market, we do like that. So what's an average covariance with the market? Well, since the market is all assets that are out there, the market's covariance with itself is going to be an average covariance with the market. The market's covariance with itself will be an average covariance. Now, we heard this once before. What is the covariance of anything with itself? The covariance of anything with itself is its variance. Remember that the covariance between A and B is equal to the correlation between A and B times the standard deviation of A times the standard deviation of B, right? Well, what about the covariance of something with itself? What is the covariance of A with A? Well, that's going to be equal to the correlation of between A and A times the standard deviation of A times the standard deviation of A. Well, what's the correlation of anything with itself? Anything in itself has to move exactly perfectly together. So the correlation of A with itself, A with A, is going to be 1 times the standard deviation of A times the standard deviation. What's the standard deviation of A times the standard deviation of A? It's the standard deviation of A squared, which is the variance of A. So the covariance of A with itself must be 1 times the variance of A, or in other words, the variance of A. So what this is telling us is the covariance of the market with the market is the variance of the market. Now, let me repeat what I said earlier. Since the market has everything in it, the covariance of the market with itself is an average covariance with the market. The covariance of the market with itself is the variance of the market. So this in the denominator is an average covariance with the market. In the numerator, we've got stock I's covariance with the market. So if stock I has a higher than average covariance with the market, this ratio will be greater than 1. If stock I has a lower than average covariance with the market, this ratio is going to be less than 1. So this is kind of important to us. In fact, it's so important, it's got a well-known name in finance. It is the beta of asset I. The beta of stock I is that stock's covariance with the market divided by the variance of the market. So if the beta of a stock is greater than 1, it has a higher than average covariance with the market, which means when we add stock I here to the market portfolio, we're adding a bunch of high covariance terms, and we are increasing the standard deviation of our portfolio. We don't like that. If stock I has a lower than average covariance with the market, then this number in the numerator is going to be less than this number in the denominator. The beta of stock I will be less than 1. So if the beta of the stock is less than 1, when we add that stock to the market portfolio, we're adding a bunch of small covariance terms, and we will be reducing the standard deviation of the market portfolio. We like that. So we like stocks with a low beta. We don't like stocks with a high beta. Well, this is starting to sound familiar. I don't like Brussels sprouts, do I? But you know what? I might be persuaded to eat some Brussels sprouts if you offer me some Boston cream pie, right? So is it true that an investor might be willing to take on a stock with a high beta, even though they don't like that high beta? And the answer is yes. If you offer them something as compensation, if you offer them a higher expected return. More specifically, what you have to offer them is a risk premium, a higher risk premium. Risk premium is the extra return you get for investing in an asset that has some risk associated with it. So let's go and take a look here to make sure we understand risk premium idea. If this is expected return, again, mean variance based standard deviation, here is my risk-free asset, right? And here is the expected return, we'll just say of asset A. There's the expected return of asset A. Well, this right here is the risk-free rate. So this right here is going to be the risk premium. The risk premium is the extra return you get as compensation for taking on some risk. Remember, the risk-free asset by definition has no risk. So anything you get above that is compensation to a risk-averse investor for taking it on. It's the Boston cream pie you get as compensation for eating some of those Brussels sprouts there. So that's the idea of a risk premium. So what we want to do is we want to ask ourselves, what is an average risk premium? Okay. If you get more than an average risk premium for taking on more than an average level of risk, what is an average risk premium? Well, we learned this a while back. Remember again that the market has some of everything in it. So therefore, the market's risk premium must be an average risk premium. R sub M minus R sub F, we said, is the market's risk premium. So that's the market risk premium right there. And we said it's not really a knowable number, okay? But we need to come up with a number, and we're going to use 5.7%. Some analysts will use numbers higher than that. Some analysts will use numbers lower than that. I've seen people use as much as 12%. I've seen some people use as low as 2% on that. 5.7% is somewhere in the middle somewhere. So at any rate, that's what we're going to do. We're going to say on average, investors expect to get an extra 5.7% on average, okay, over a long period of time for taking on that extra risk of the market. So for an asset that has more than an average covariance with the market, the investor expects to get more than the average risk premium. If an investment has, if a stock has lower than average covariance with the market, they are willing to accept a lower than average risk premium. Remember, we don't like covariance with the market because when you add a bunch of small covariance terms here, it reduces the standard deviation. If you add a bunch of high covariance terms, it increases the standard deviation. And so if your beta is greater than 1, you are going to require a higher risk premium. If your beta is less than 1, you're going to be willing to accept a lower risk premium. And if your beta is exactly 1, well, you're willing to take an average risk premium. So guess what we can do? We can simply multiply the market risk premium by the beta of stock I. So if the beta of stock I is 1, stock I gets an average risk premium, which is the market risk premium. If the beta of stock I is greater than 1, which means it's going to increase the standard deviation of our market portfolio, stock I will get a higher than average risk premium. And if the beta of stock I is less than 1, it's going to get a less than average risk premium. So the beta of stock I multiplied by the market's risk premium is stock I's risk premium. So that is stock I's risk premium. So the market risk premium, which we're using the number 5.7%, is the extra return. If this was the market up here where I got A, if that was the market, it's the extra return that the market gets above the risk-free rate. The risk premium for stock I is its beta multiplied by the market risk premium. And the reason why we're using the stock's beta is because if the stock has a high covariance with the market, it's going to have a high beta. If the stock has a low covariance with the market, it's going to have a lower beta. And we're not interested in the risk of stock I. What we're interested in is how does stock I affect the risk of the market portfolio when I add it to the market portfolio. And we're interested in that because everybody's going to be owning the market portfolio. That's the only risky asset that people are going to invest in so that they can get on this capital market line because they want higher expected returns and lower standard deviations. All right, so if this right here now is going to be the risk premium for stock I, what is the total expected return for stock I? So the expected return for stock I is going to be equal to stock I's risk premium plus the risk-free rate. So the risk-free rate is the rate of return you get if there's zero risk, and then this over here is going to be stock I's risk premium. So the total return for A is going to be the risk-free rate plus A's risk premium, right? The expected return for stock I is going to be the risk-free rate plus stock I's risk premium. And stock I's risk premium is stock I's beta times the market risk premium. And remember, stock I is just a generic stock. It's any old stock. Well, this is a very famous equation right here, okay? It is called the capital asset pricing model, oftentimes called the CAPM for short. And it got at least two different people Nobel Prizes for it, okay? It is not the only pricing model that is out there. There are quite a few other pricing models, but it is the oldest. It is by far the most widely used. And it is one that if you it's probably the easiest to understand. And it's the only one we're going to be going through in this particular course. So if you understand the capital asset pricing model, it's easy to understand other asset pricing models as well, or easier to understand some of the other pricing models. So I want you to understand that this is not the only model that people will use to price assets. It is not, but it's the only one that we will use to price assets. So this is how we come up with the expected return or required return for an individual asset. We say investors expect at least the risk-free rate, and then if it's a risky asset, they expect a risk premium. How much risk premium? Well, the market risk premium is an average risk premium. If the stock has a beta greater than 1, that means that it's a higher than average covariance with the market. They get a higher than average risk premium. If a stock has a beta less than 1, that means that is a lower than average covariance with the market. They're willing to accept a lower than average risk premium. And if the stock's beta is exactly 1, then they get an average risk premium. So the risk-free rate plus the stock's risk premium is the expected return on the stock. That's the capital asset pricing model. Now, we'll talk about the capital asset pricing model a little bit more, and we'll start to use it in some in some formulas, in some ways to be able to price some assets in our next video.